As Donald Trump returns to the White House, a ripple effect is spreading across the Atlantic, reshaping Europe's real estate landscape. Today, we're diving into how this political shift could transform property markets from London to Berlin. The numbers tell a compelling story. The 10% tariffs proposed by Trump could impact Europe's GDP by up to 1.5%. That's a staggering €260 billion effect on the economy. But what does this mean for property markets? Reduced economic growth, assuming other factors remain unchanged, could adversely affect real estate markets in Europe, particularly in the leasing sector, as export-dependent businesses in the region may experience a slowdown in their operations. This economic pressure could trigger three key changes: European Central Bank rate adjustments, a weaker euro, and a shift in property valuations. Concerns are already looming over the construction and real estate sectors, as the 25% US tariffs on steel and aluminium are expected to be implemented in short order, with the potential to significantly raise material costs and disrupt supply chains across Europe. The UK steel industry has warned of a potential £400 million export hit. In response, the EU has vowed to retaliate. President of the European Commission Ursula von der Leyen declared, "Unjustified tariffs on the EU will not go unanswered. They will trigger firm and proportionate countermeasures." Despite these challenges, there are still a range of opportunities. Political uncertainty in the US is driving a fascinating trend. We're seeing increased interest in European properties as investors seek stability across the Atlantic. As history shows that the Trump administration triggers volatility, markets like Portugal are emerging as safe havens, attracting investors who want to diversify away from the US political context. This isn't just about returns anymore. It's about finding political and economic stability. The residential sector in Europe is expected to perform relatively well compared to other sectors, particularly given the ongoing housing shortage and continued upward pressure on rents. Trump's return to power is expected to increase pressure on NATO countries to meet defense spending targets. As a result, European countries are likely to increase regional defense procurement, driving a significant rise in demand for manufacturing facilities, warehouses, and logistics space to support this expansion. CBRE Investment Management predicts a 15% increase in European real estate investment activity in 2025, as savvy investors find quality assets at discounted prices across Europe. This market dislocation isn't just a challenge, it's creating opportunities for those who know where to look. Top industry leaders attending the exclusive GRI Global Chairman's Retreat 2025 expressed an outlook of cautious optimism for the future under this new administration. As we move forward, the European real estate market's resilience will likely depend more on local factors than US politics. The European Central Bank's policies and regional economic strength continue to be the primary drivers. Experts suggest focusing on local market fundamentals, ECB monetary policy, regional economic indicators. As Europe's property market adapts to this new political reality, one thing is clear. While Trump's presidency may create short-term waves, the European real estate market's strong fundamentals and stability continue to attract global investors looking for reliable returns. The question isn't if European real estate will remain attractive, but rather which markets will emerge as the strongest performers in this new global landscape. Stay tuned to learn more.